Okay, so you want to own a casino. Not a slot parlor, not a riverboat, a real one. Vegas strip lights, a marquee with your name on it. High rollers dropping six figures at the baccarat table while you watch from a glass office upstairs. You picture the house always winning. Every hand dealt, every reel spun, the odds tilted permanently in your favor, and the money just piling up while other people gamble it away. That is the picture. That is what the movies sell you. Here is what they don't show you. The 11-figure construction loan that has to be serviced whether the casino floor is full or empty. The comped rooms, comped meals, and comped private jets that fly your best customers in for free because the casino that doesn't spend money attracting whales doesn't have whales. The single high-stakes gambler who can walk away in one weekend with more of your money than 1,000 tourists lost to you all year. And the fact that some of the most famous casinos ever built in America went bankrupt, not because gamblers stopped gambling, but because the mathematics of the house edge, real as it is, was never the thing that determined whether the business survived. A casino is one of the strangest businesses in the world because it is the one industry where the core product has a guaranteed, provable mathematical profit margin built into every single transaction, and it still manages to go broke on a regular basis. By the end of this, you will understand exactly why that happens, and why the house always wins in the short run and sometimes still loses everything in the long run. Before the money, we need to separate what a casino actually is because like a lot of businesses that sound like one thing, casino is really an umbrella term covering several very different operations that just happen to share a gaming floor. There is the Las Vegas Strip mega resort, the kind with thousands of hotel rooms, multiple towers, a convention center, a dozen restaurants, and a casino floor that might only be 5 or 10% of the total square footage. There is the regional casino, the kind you find off a highway exit outside a mid-sized American city, usually a single building with a parking garage, a modest hotel or no hotel at all, built to serve locals rather than tourists. There is the tribal casino, operating under a completely different legal and tax structure through agreements between sovereign tribal nations and state governments. There is the riverboat or dockside casino, a category that exists purely because of old state laws that only permitted gambling on water, some of which still technically float even though nobody expects them to leave the dock. And there is the small, high-limit private gaming club, sometimes just a few tables in a converted building, built entirely around a handful of extremely wealthy players rather than mass tourism. These are not the same business. A strip resort is closer to being a hospitality and entertainment company that also runs a casino. A regional highway casino is closer to being a single-purpose gambling machine with a restaurant attached. Both get called casinos. Both have almost nothing in common financially. This script focuses mainly on the strip-style resort casino, the one people actually picture when they imagine owning one, while pointing out where the other models diverge. The first thing that breaks the naive mental model is the price of admission. You don't build a casino, you build a small city, and the casino is just one wing of it. A modest mid-tier strip property can run anywhere from a few $100 million to build. A large-scale luxury resort routinely runs $1 to $2 billion. The most expensive properties ever built on the Strip have pushed past $2.5 billion, and a small number of ultra-luxury projects worldwide have crossed the $4 billion mark. Land alone in a prime Strip corridor can run roughly $1 million an acre, and a serious resort footprint needs dozens of acres. Break the construction budget into its pieces and the picture gets clearer. Standard hotel rooms cost somewhere between $150,000 and $500,000 each to build out, and a serious resort casino isn't opening with 100 rooms. It's opening with 2, 3, sometimes over 4,000 of them. The actual gaming floor, the part everyone assumes is the expensive part, runs somewhere between $500 and $1,200 per square foot once you account for the flooring, the lighting rigs, the surveillance infrastructure, and the acoustic design that keeps a room full of slot machines from sounding like a demolition site. Restaurants and bars inside the resort run anywhere from $300,000 to $1.5 million each to build, and a serious property needs 8, 10, sometimes 15 of them under one roof. Add the convention space, the spa, the theater for the headline residency shows, the pool complex, the parking structure, and you start to see why the final number for a full strip-scale resort casino routinely lands somewhere between $1 and $2 billion before a single card has been dealt. Here is where a casino diverges from almost every other large real estate project. Because unlike a hotel or an office tower, you cannot open the doors the day construction finishes. You need a gaming license, and that is a different kind of expensive. Licensing fees for a full commercial casino license can run into the hundreds of thousands of dollars annually just in base fees, before you count the cost of the process itself. A serious license application involves full financial background checks on every major investor, every executive, sometimes going back decades, conducted by state gaming control boards with the authority to reject an applicant for almost any reason connected to financial history or personal conduct. Legal and compliance costs to get through that process on a large resort project can run into the tens of millions of dollars by the time attorneys, auditors, and consultants are finished. Ongoing annual compliance, audits, and regulatory costs for a mid to large property typically run somewhere between a few $100,000 and a couple $1 million a year, every year for as long as the doors stay open. Then comes the gaming equipment itself. A single slot machine, the boring beige box that looks like nothing, costs somewhere between $20,000 and $35,000 new. A strip-scale floor might carry 2,000 to 3,000 of them. Do that math, and the slot floor alone before a single blackjack table is delivered can represent $25 to $75 million of equipment. Add table games, custom felted tables, chip inventory, shuffling machines, and the surveillance and cage cash management systems that track every dollar moving through the building, and total gaming equipment and systems on a large property can exceed $60 million on their own. Total it up: land, construction, licensing, gaming equipment, and enough cash reserve to survive the ramp-up period before the property is running at capacity, and a serious strip-style casino resort needs somewhere in the range of $1.5 to $2.5 billion before it has made a single dollar of gaming revenue. Once the doors open, the operating cost structure looks less like a small business and more like running a mid-sized city. A large resort casino can employ anywhere from 5,000 to 12,000 people: dealers, pit bosses, surveillance staff, housekeeping, security, valet, entertainers, chefs, and an enormous back office running finance, marketing, and compliance. Payroll on a property that size can easily run into the hundreds of millions of dollars annually. Utilities are their own category of pain. A strip resort runs 24 hours a day, every day of the year, with no closing time, no slow season where the lights go off, no holiday where the air conditioning shuts down. Nevada summers push outdoor temperatures past 110 degrees, and keeping several million square feet of casino floor, hotel rooms, and convention space cool around the clock is a monthly utility bill that can run into the millions of dollars for a large property. Maintenance and refresh costs are a quieter drain. A casino floor gets used by tens of thousands of people a day, every single day. Carpet, upholstery, and fixtures wear out far faster than in almost any other commercial setting, and industry estimates put annual maintenance and refresh spending at somewhere between 2 and 3% of total property value every single year. On a $2 billion resort, that is $40 to $60 million a year just to keep the building from looking tired. And then there is marketing, which for a casino is not really marketing in the traditional sense. It's closer to a direct subsidy paid to your best customers. Here is the idea that explains everything else about how a casino actually makes money, and it has almost nothing to do with the felt on the tables. The house edge is real. On slot machines, it typically runs somewhere between 2 and 15%. Depending on the machine and the jurisdiction, meaning for every $100 fed through the machine over the long run, the casino keeps somewhere between $2 and $15. On table games, it's thinner. Blackjack can run under 1% with perfect play. Roulette runs between 2.5% and 5.25% depending on the wheel. Baccarat sits close to 1%. These numbers are not secret, and they are not a scam. They are published, audited, and provably accurate over millions of hands. In the long run, mathematically, the house always wins. But here's the problem with that sentence. The house edge only pays off over an enormous number of bets, and the number of bets any single high-value customer places in a single trip is nowhere near enough for the law of large numbers to guarantee anything. A single whale, an industry term for a customer capable of wagering enormous sums, can sit down at a private baccarat table and bet $100,000 a hand for an entire weekend. Over a short enough sample size, that player can walk away up several $1 million, and there is nothing mathematically unusual about that. It happens. It happens regularly. A casino built entirely around confidence in the house edge can still lose an enormous amount of money to a single guest in a single weekend, purely because of variance. This is why the entire economics of the high end of the casino business isn't about avoiding that risk. It's about managing it and paying for the privilege of taking it. A whale who plays that kind of volume is worth pursuing, even accounting for the chance of a bad weekend, because averaged across dozens of trips over years, the house edge does eventually assert itself. But the casino has to survive the individual bad weekends to get there, and some casinos don't. This is where the comp economy comes in, and it is one of the strangest, most deliberately engineered pieces of consumer psychology in any industry. A high-value player doesn't pay for their hotel room, doesn't pay for dinner, doesn't pay for the show tickets, the spa treatment, or in the most extreme cases, the private jet that flew them in. All of it is comped, given away for free, calculated against the expected value the casino projects that player will lose at the tables over the course of the visit. The math behind this is not guesswork. Casinos calculate a theoretical win figure for every significant player, based on average bet size, hours played, and the house edge of the specific game, and then they compare that theoretical win against the actual cost of comping the player's entire trip. If a player's average bet and hours played suggest a theoretical loss of $50,000 over a weekend, comping that player $20,000 in rooms, food, and travel is a rational business decision because it keeps that player coming back for the next trip and the one after that, each one adding to the theoretical win the casino expects to collect over the relationship. This is why casino hosts, the staff whose entire job is managing relationships with high-value players, exist as a dedicated department with real budget authority. It's why loyalty programs track your play down to the dollar and the minute. It's why the free drinks keep flowing on the gaming floor while a bottle of water in the gift shop costs $6. None of it is generosity. It's a customer acquisition and retention cost, calculated against a specific mathematical model of expected future losses, applied at an individual level to the customers who matter most. For the ordinary tourist playing $20 blackjack for a few hours, the model is completely different. That customer isn't worth a personal host or a comped suite. They're worth a free drink while playing, and maybe a discounted room rate booked through a travel site. The entire building runs on this same principle. Wall Street analysts call yield management, extracting the theoretical maximum value from every tier of customer, from the whale flown in on a private jet down to the retiree feeding a nickel slot machine for 3 hours on a Tuesday afternoon. Underneath the gaming floor sits an entire industry of quiet, sophisticated psychology built to keep people playing longer than they intended to. Slot machine layouts are designed by behavioral consultants, not interior decorators. There are no clocks visible on a casino floor, and in older designs there are famously no windows either, removing every natural cue that tells a person how much time has actually passed. Machines are engineered around what the industry calls near-miss design, arranging symbols so that a losing spin often shows 2 matching symbols and a third that just barely missed, a pattern proven to keep players engaged even though a near-miss carries exactly 0 mathematical significance toward the next spin. Complementary drinks lower inhibition and slow decision-making. The physical layout of a casino floor is deliberately maze-like, with table games and restaurants placed to maximize the distance a guest has to walk past slot machines to get anywhere, and exits are rarely obvious from the center of the floor. None of this is illegal. All of it is well documented in gaming industry design literature, and all of it exists for a single purpose, extending what the industry calls time on device, because every additional minute a person spends playing is another set of bets exposed to the house edge. If the mathematics of the house edge were the whole story, casinos would never go bankrupt. They do, regularly, and the reason is almost always the same one that sinks any highly leveraged real estate project. It isn't that gamblers stopped gambling. It's that the debt used to build the palace outgrew what the palace could ever realistically earn. The clearest example sits on the boardwalk in Atlantic City. A multi-billion-dollar resort broke ground in the years before the 2008 financial crisis, backed by a major Wall Street investment bank, designed as a completely different kind of casino resort, a seaside luxury destination that happened to include gambling as one of its features rather than the center of the experience. Construction ran into the crisis. Funding dried up midway through, and by the time it finally opened years late, the building had cost roughly $2.5 billion, an amount so large that even a fully successful casino at that location would have struggled to service the debt. To make things worse, The ownership made a series of positioning decisions that alienated the exact gambling audience the property needed, including banning smoking on the casino floor at a time when most competitors still allowed it, skipping the bus tour and players' club infrastructure that brought in the steady, high-volume regional gamblers most Atlantic City casinos depended on, and pricing rooms and restaurants at a level that assumed a wealthier guest than the market was actually delivering. The casino opened, brought in some of the lowest gaming revenue of any property in the city in its first month, burned through cash at an unsustainable rate, and filed for bankruptcy less than a year after opening. It filed again a year after that. It closed permanently a little over 2 years after its grand opening, having lost billions of dollars for the investors who backed it and having employed thousands of people who lost their jobs when the doors shut for good. It was eventually sold off for a small fraction of what it cost to build. The lesson underneath that story is structural, not moral. The casino's house edge worked exactly as designed on every single hand played inside that building. The math wasn't the problem. The problem was that Atlantic City's total gambling market had been shrinking for years as neighboring states legalized their own casinos, pulling away the very customers the new property needed to fill its enormous debt obligations. A gorgeous, mathematically sound casino sitting inside a shrinking market and carrying an unsustainable debt load can still collapse completely, and the emptiness of the parking lot outside told that story long before the bankruptcy filing did. Strip the whole business down to its operating engine and the math looks like this. A large regional casino running 1,500 to 2,000 slot machines, generating something like $200 to $400 in daily win per machine, produces somewhere between $300,000 and $800,000 a day in slot revenue alone. Add table games revenue on top, and a serious property can generate well over $1 million a day in total gaming win before counting hotel rooms, food, beverage, or entertainment. Against that revenue sits a genuinely enormous fixed cost base, payroll for thousands of employees, debt service on a construction loan that can run into hundreds of millions of dollars annually on its own for the largest properties, utilities running around the clock, maintenance eating 2 to 3% of property value every single year, marketing and comp spending that can represent a substantial share of gaming revenue for properties competing hard for high-value players, and gaming taxes, which vary enormously by jurisdiction. Nevada keeps this relatively low, at just under 7% of gaming revenue, which is one of the reasons Nevada casinos can afford to be more generous with comps and reinvestment. Some other states tax table games revenue at rates above 50%, which forces operators in those markets to lean far more heavily on slots and non-gaming revenue, like hotel rooms and entertainment, just to make the math work. In a strong year with high occupancy, strong gaming volume, and a well-managed comp program that keeps the highest value players coming back without giving away more than their theoretical win justifies, a large resort casino can post a healthy double-digit profit margin on total revenue, translating into tens or even hundreds of millions of dollars of annual profit on the largest strip properties. In a difficult year, a regional economic downturn that reduces discretionary gambling spending, a new competing property opening nearby and pulling away volume, an unusually large string of bad luck against a handful of high-stakes players, or a spike in the cost of debt during a period of high interest rates, that same property can see its margin compress into low single digits or vanish into a loss entirely, even while the parking lot still looks reasonably full most nights. The gap between those two outcomes on a large property can run into tens of millions of dollars in a single year, and almost none of that swing is visible from the casino floor. No fire, no scandal, just a slightly softer month of high-end play, a slightly higher debt service payment, and a slightly larger comp bill compounding quietly until the number at the bottom of the income statement looks nothing like the projection. If the operating margins are this exposed to leverage and volatility, it's worth asking why sophisticated investors keep buying casinos anyway. And the answer runs parallel to why wealthy landowners buy ranches they'll never make money farming. A well-run casino generates enormous, predictable cash flow even in an average year because the house edge, while not a guarantee on any single weekend, is a near certainty over the volume a large property processes across an entire year. That cash flow supports real estate that keeps appreciating in some of the most land-constrained, high-demand corridors in the country. It supports a vertically integrated business, hotel rooms, restaurants, entertainment, retail, all cross-selling off the same customer base drawn in by the gaming floor. And because gaming licenses are difficult, expensive, and slow for regulators to approve, an operator that already holds one enjoys a real barrier to entry that keeps new competition from flooding in overnight. This is why the largest casino operators in the world are not usually gambling enthusiasts. They're real estate and hospitality conglomerates that happen to have a mathematically guaranteed profit center sitting in the middle of their property. And they run the whole operation the way any large hospitality company runs a portfolio, chasing occupancy, average spend per guest, and the lifetime value of the customer, with the gaming floor as the single most efficient revenue engine in the building. So can owning a casino make you rich? Yes, it genuinely can, and the mathematics behind it are more provably in your favor than almost any other business you could build. But the way it happens rarely matches the picture people carry around in their head. It isn't a vault filling up with cash from tourists at the slot machines. It's the outcome of surviving years of debt service on a building that costs more than most cities' annual budgets, managing a comp economy that pays your best customers to keep showing up, absorbing the occasional catastrophic weekend where a single player walks away with millions of your dollars purely by chance, and doing all of it in a jurisdiction and a market that isn't quietly shrinking underneath you the way Atlantic cities did. The house edge is real. It is not the thing that decides whether you win or lose this business. The debt is, the market is, and the discipline to survive the bad years long enough to let the math finally do what it was always going to do eventually is the actual business you're signing up for the moment you buy the building.